Hello, and welcome to this latest episode of the Friends of Sanctuary podcast. I'm Marianne Bartels, Chief Investment Strategist at Sanctuary Wealth. Today, I am very pleased to welcome our guest, Ryan McCormack, Senior Factor and Core Equity Strategist at Invesco. Ryan, thank you so much for joining me.
Thanks, Marianne. It's great to be here.
It is so wonderful to see you. We worked together for a number of years while we were at Bank of America.
Yes.
And those were a lot of fun years. I have a lot of fond memories of working with you. So I really appreciate you being here today.
Me too. And thanks again for having me. This is great.
And you're really an expert on exchange traded funds, which are called ETFs.
Yes.
And my understanding is Invesco, and this surprised me when we were having our conversation, has about 220 ETFs on their platform, and you cover about half of them.
Just about 100 equity ETFs. Yeah.
That's a lot to cover. That's a lot of ticker symbols to remember.
It's a lot of tickers. A lot of tickers.
Okay, so QQQ. Everybody, I think, knows QQQ.
Yep.
They may not know what QQQ is, but they've heard of QQQ because you guys have the best commercials. I have to say, for some of the best commercials and memorable commercials. Now, the QQQs really follow an index called the NASDAQ 100.
Yes.
So we have the NASDAQ composite, which has a lot of stocks. The NASDAQ 100 pretty much has the top 100 equity names in it. Is that correct?
Yes, top 100 ex-financials. So
ex-financials.
No financials in that index.
Okay, that's important. That's important
Yes.
to know. And I think a lot of people got to know it as technology has grown and the Magnificent Seven, or FANG. It used to be FANG.
Yep.
We used to talk about FANG. Now we've done Mag 7, and I think now we have Mag 4. It's a lot of iterations.
Always.
And your index covers a lot of them. When I'm out talking with clients, I've nicknamed the NASDAQ 100 or the QQQs the digital index, right? We're moving into the digital era. And now that AI or artificial intelligence is so popular, I think your index, I think that's another, I'm just doing a plug for you. You might want to refer to yourselves as the digital index. You're also celebrating 25 years of this index.
Yep. That's
wild.
I know.
So tell me a little bit, why don't you tell our audience a little bit about the QQQs?
Sure. So I think, maybe we'll go a little bit back in time, right? So the NASDAQ 100, it was launched back in January of 1985. And it was the 100 largest names listed on the NASDAQ exchange, ex-financials. So we said before, right, this is an important point to note because I think it's shaped kind of the underlying constituents and what this index has looked like over the past 30 some odd years. I always like to joke, it's ex-financials because on the same day back in January of 1985, NASDAQ also launched the NASDAQ Financials Index, which I think at the time it was the one believed to have a little bit more commercial viability. And, again, of course, over those 30 some odd years, it may be, better to be lucky than good. The NASDAQ 100 has kind of blossomed into this preeminent large cap growth index. And I don't really talk too much about the NASDAQ Financials Index.
Isn't that interesting?
So QQQ, it was launched in 1999 by NASDAQ. And it was originally called the NASDAQ 100 Tracking Stock. And this was in like the early days of ETFs, right? SPY had been launched in 1993, just a couple of years before. And it offered a way for investors to get access to this index in one ticker on exchange. And that was really kind of the game changer in the world of ETFs, being able to access a basket of stocks that are traded on exchange. And from that time, right, over the past 25 years, we've seen QQQ really become, in many cases, an incredibly well-known ticker, right? Whether it be just through performance, the names that are in there, or a handful of catchy commercials over the past couple of years, and is now the 5th largest ETF listed. It's the 2nd most actively traded fund in the world. That's based on average daily value traded, anywhere from $18 to $20 billion a day get traded on the secondary. And I think there's just a ton of name recognition and familiarity amongst the investing community when they think of QQQ. QQQ.
Well, QQQ is very fond in my heart. But you have a whole family of Qs.
Yes.
Right? There's a lot of innovation around that. Why don't you talk about the suite of innovation you've done around the Qs?
Sure. So, over the past 25 years, we really have enjoyed a pretty nice halo effect, right? It's Invesco QQQ. In the commercials, you kind of get people thinking immediately towards, the connection between the fund and the broader firm. And I think because of that, a lot has changed over the past 25 years. Not only kind of what the stock market looks like, what companies exist within a fund like QQQ, but also the types of strategies that you can fit inside the ETF wrapper. So from our perspective, it was, this is a good advantage. This is a good time to take advantage of that halo effect. And we launched first QQQM. Also, I always say this, if you hate the letter Q, I'm going to be a horrible guest. So I apologize in advance. But we launched QQQM, which also tracks the NASDAQ 100. There's some subtle nuance in that QQQM was launched as an open-ended ETF, whereas QQQ back in 1999 was launched as a unit trust. So SPY also launched as a unit trust. It was really just a more popular structure at that time to bring these sort of strategies to market. But again, over the past quarter century, right, the ETF has offered distinct advantages as compared to the UIT structure that we think could benefit the long-term kind of buy and hold investor. So right off the bat, you have QQQM at a 5 basis point reduction in expense ratio, 15 basis points versus 20. Beyond that, within the ETF structure, you're able to engage in securities lending, which you're not in the UIT structure. So quite simply, lending out shares of the companies that we hold for a fee that comes back by the way of revenue for the fund, and it's used to offset expenses. Similarly, the ETF is able to reinvest dividends at the fund level. So if we get a dividend from, pick a company, Microsoft, in QQQM, we can reinvest it back into the index versus QQQ, which needs to kind of keep it off to the side in cash. So it reduces cash drag that exists on the portfolio. It should mimic the index performance a little bit more closely. And ultimately, over time, we think that this can provide better NAV performance to the shareholder. And since that launch, we've seen about 41 basis points of outperformance from QQQM versus QQQ. From there, I guess this would be the child. So the child of the NASDAQ 100 family would be the NASDAQ Next Generation Index. So take the NASDAQ 100, the 100 largest ex-financials listed on NASDAQ. We're going to look at the 100 just below that.
Hoping that they'll go up into the NASDAQ 100 over time.
Exactly right. It's like a story of graduates, right? So, we look back through the course of the past, 15 years or so, and companies like a Tesla or Netflix would have made the jump from NASDAQ Next Generation into the NASDAQ 100. So it's looking at some of these companies that may be at an earlier stage of their growth cycle and trying to capture that performance again before they reach large cap or even mega cap and get called up into the big leagues, so to speak, make it into the NASDAQ 100.
What kind of adoption have you seen for these ETFs? So
for QQQM, we've seen a pretty fair adoption right off the bat. We're looking at since inception, well over $15 billion of inflows. I think it still is Invesco's most successful ETF launch. With QQQJ, we saw a lot of inflow right off the bat, right around $1 billion in the first handful of months of the ETF coming public. We've seen a little bit of a back off, just given kind of where the mid cap and small cap world has been over the past, let's call it 3.5 years.
They've been underdogs.
It's been a challenging space. So we've sort of seen, that interest kind of ease off a bit. But, again, with small and mid cap flows, a lot of times we'll see it ebb and flow, right? We'll see years of strong demand, and other years, with performance maybe being a bit of a headwind, we'll see inflows slow. But we've had a lot more conversations on QQQJ, as well as the small cap offering, which is QQQS. So this one's a little bit differentiated. So we use patent valuation in this one. And basically we looked at NASDAQ, and if we're calling it the innovation suite, and I can talk your ear off on innovation, but as we started to go down cap, we started to see representation from sectors that aren't really intuitively all that innovative. So, as we're looking and working with NASDAQ in the creation of this index and the fund, we noticed that if you use a metric like patent valuations, a lot of times that will kind of lend itself to companies that have a history of innovating or have really exciting things that may be on the horizon. So what we did here was look outside of the NASDAQ 100, outside of the NASDAQ Next Generation Index, into everything else that's left, ex financials and real estate. And we use a company based in Europe, IPR Strategies. They're one of the leaders in terms of patent valuations used by a number of research firms, government, within M&A, et cetera. And we assign a value of these companies' patent portfolios. We look at that value relative to their market cap, almost as a way to uncover companies who may have underappreciated patent portfolios. And we take the 200 names based on patent value versus market cap and equally weight them. And what we found is that leans more towards the small cap side, small cap growth side of the equation. So we thought it was a really healthy and easy way for us to round out our innovation suite, going from large cap to mid cap to small cap.
So I'm going to pretend I'm a client.
Yep.
And I call you up because I'm comparing QQQ to QQM, and I don't know which one to invest in.
Mm-hmm.
What would you say to a client? How do you know if it's the QQQ or QQM?
Yeah, and I think ultimately it's an easy question. What's your time horizon? How long are you going to be holding the fund for? And if it's longer than 2.5, 3 months, I'm going to lean towards QQQM. So with QQQ, right? It trades a ton. So the bid-ask
So
spreads.
there's a lot of traders that trade QQQs.
I think
too.
it's very easy because your bid-ask spreads are so tight, and there's so much liquidity and volume on the secondary that for maybe an institution or a faster money larger player that just wants to take a view on large cap growth for a week or two. Right? If it's something that's event driven, it's very easy to get exposure to that area of the market through Qs. And at that point, the 5 basis points of expense ratio probably doesn't make a material difference for what they're trying to accomplish. But for most that are, hey, I'm going to use this as my large cap growth allocation within my broader portfolio for the better part of the next 5, 10, 15, or beyond years, we think that the lower expense ratio, as well as kind of the added benefits that the ETF structure brings, we think that should help to make a difference over that longer holding period. And that's where I would steer somebody towards.
Where you
QQQM.
said you had that like 45 basis points outperformance, you get to collect the dividend. Right?
Yeah, the dividend gets reinvested at the fund
back
level.
in.
Yeah, so you just see better NAV performance, and that's exactly right. Just in 3.5 years, we've seen that 41 basis points of excess
41.
performance. But over the course of 3 years, 41 basis points, it's not lighting the world on fire, but you're tracking the same basket of stocks, and over time, and the use of compounding, of course, that can start to add up.
Now, with the other suite that you talk about of innovation, has that been widely adopted, or are you finding the retail community just learning about that suite?
Yeah, just learning about it. I think these indices are new, right? The NASDAQ 100 has been around since 1985, and looking down cap in the NASDAQ composite, there's a certain level of education that's needed, where it fits in the portfolio, how it behaves, why it will behave the way it does. Whereas with the NASDAQ 100 or even QQQ, you have 25 years of live performance to get a pretty decent understanding of what these stocks look like, what the underlying index looks like, and how they'll behave. So I think we're still sort of in educational ramp-up mode.
So if somebody that's watching this wants to learn more, can they go up on Invesco's website and learn anything?
Yeah, absolutely. Certainly on Invesco's website, I think we have a number of resources, whether it be our consultants that are out in the field, our ETF specialists that are out in the field. I'm always willing and happy to jump on calls. I do fairly frequently. So we have a pretty large support system for advisors that want to talk a little bit more on the educational front. What makes this ETF different from another one? And I would encourage them to utilize us.
I would encourage them too, because some of the things you talked about, I was unaware of. So I'm going to have to learn a little bit more. Another suite of what I have found to be very popular ETFs, especially as the market has concentrated towards the mega caps, people kind of felt that wasn't a true representation of what was happening in the markets, particularly last year. So I found people starting to use equally weighted ETFs from Invesco. You have one for the S&P, and you have them also for the S&P 500 sectors, but equally weighted. Can you walk our viewers through what these ETFs are?
Yeah, absolutely. So the one that's most familiar would be RSP. As you said, the S&P 500 equally weighted ETF. It was the first smart beta ETF launched. So basically anything, I like to say anything that uses a metric other than market cap can be considered kind of smart beta. But RSP was the first alternatively weighted smart beta ETF launched, and that was back in 2003. So last year we celebrated 20 years of
I was going to say, that's a long time. And again, not one I heard a lot about, but I did last year.
Yes. So, it's one that's been around, and like the best part about it is like it's the easiest smart beta ETF that I can describe. Like you're taking all 500 constituents of the S&P, you're giving them an equal weight, and you're rebalancing on a quarterly basis. That's it. But truthfully, I mean, I think the beauty is a little bit in the simplicity there, because there's not going to be much deviation in terms of what to expect on a quarterly basis. You're going right back to everything having about a 20 basis point weighting. And with it, it's a way to naturally kind of diversify away from Magnificent Seven or concentration in an underlying index, because let's say the 471st, 474th, and 480th weighted companies in the S&P get the same weighting as Amazon, Microsoft, and Apple.
Right.
So you're picking up a lot of the small size factor, right? Just going down cap in that regard. And because you're giving those smaller names the same weightings as your Apples and Microsofts, right? You're inherently kind of moving away from the concentration that may exist at the top of the index.
I think the other thing where it could help clients, if you have a concentration risk in a particular company that happens to be very large in the S&P, but you still want to have exposure to the market. It's another way of kind of trying to get exposure and not having particular concentration risk. Do you ever talk about that?
100%. I mean, we'll look at it from a different couple of angles, right? I look at a company like Apple, right? And you can kind of equate it to like the ExxonMobil of the 70s and 80s, just a huge wealth creator in the United States. And it's developed, I think, an army of fans that will never move away from their Apple stock. And that's fine, right? I mean, to a certain extent, like there are people that feel a deep emotional connection to a certain security, and they just refuse to want to move away from it, or all of it, let's say. Within that, what you get is across the portfolio, unintended concentration exposure. So if you pull up Google or you go on CNBC, right, they're talking about concentration that exists at the top of the S&P, whether it's your top 5 holdings, your top 7, your top 10, it's rather concentrated. I think if we take it a step further and look to the large growth area of the market or large value portions of folks' portfolios, you'll see these same names like Apple and Microsoft at times showing up on the value side of the equation, certainly showing up on the growth side of the equation. So for investors that may think, I'm using value and growth, that I'm going to be well diversified, I may not have this concentration risk. Maybe not, right? I think we need to look under the hood there. So over the course of all of this, right, whether it's a single security that you have a large weighting in, or whether you start to look under the hood of your various segments of the large cap investing universe and realize, I didn't think I had this much exposure to a given name. RSP is just a really easy way to introduce a differentiated return stream. You're getting exposure to the U.S. large cap equity market, but you're doing it in a way that looks a bit different, picking up that small size exposure and leaning a little bit to the value side.
So let's switch to the equally weighted sectors, because now the sectors in the S&P have a lot of concentration risk, more than I've ever seen in my entire career. Obviously, you have certain tech names in technology, but communication services, which used to be telecom, but now includes companies like Google and Meta. You have Amazon in consumer discretionary, that you get this single stock or a couple of stock concentration at the sector level.
Yes.
So, but you do this also now equally weighted for the sectors. Why don't you talk a little bit about that and the benefits?
Exactly. And I think that's the main benefit, right? I mean, you're looking at sectors. You may want to play the world of consumer discretionary, right? You may think, okay, the American consumer is back, retail sales are going to be up, like I want discretionary spending. But you may not necessarily want Amazon, Tesla, and Home Depot, which makes up, close to half of the underlying sector, right? You want a broader representation of that play, that potential outcome. So in a really easy to explain way, we take the S&P 500 consumer discretionary sector and we equal weight all of the names. So we've had more conversations on things like consumer discretionary, things like technology, where you're starting to see, even in the underlying sector, names like Apple and Microsoft and Broadcom and NVIDIA start to rise to the top and take a larger and larger share. But again, folks that want to express an overweight view or a way to get exposure to some of these sectors or sub themes without necessarily having to overload on these names that they may hold already elsewhere.
So you talk to a lot of people, and what are you seeing in terms of what clients are currently using or currently interested in? Are you like last year was all about equal weight? Are they still talking about equal weight? Are you getting more questions about your innovation suite? What are some of the top questions that you're getting from advisors and clients?
Yeah. So I think on the question front, I mean, the first one is, well, how do I invest in AI?
I should have asked that question, right? Number one question, right? Because it's normally NVIDIA or Google, a company that has AI.
Right.
Digital, QQQ.
Exactly.
QQQM, if you're a long-term holder. I'm learning, Brian.
Exactly.
I'm learning.
But like, where does it all fit in, right? And,
Yeah.
It's, the headlines can be very broad, but without really saying much. And people hear about AI and, okay, that's great. It's going to change the world. But well, how do I do it, right? And sure, NVIDIA thus far has been a clear-cut winner. But that's a question I get fairly frequently. And I think with the Qs, being that is, as you like to call it, the digital index, the 21st century industrials, right? Any way you slice it, Qs has always had a very close relationship with technology, right? Sort of attached at the hip. And even if you look at the underlying sector representation, right? It's not all technology. You get the consumer discretionary, you're getting the communication services, actually picking up a little bit of like differentiated healthcare from the medical device side, as well as some select biopharma names. But it's growth oriented, not necessarily just technology. And then I like to joke, like, technology, it's harder and harder to put a company into a designated technology box, especially compared to 25 years ago. But we try to figure out, okay, well, what are these companies engaging in? What has made them very successful? And why are people making the sort of the connection between the NASDAQ 100 and a theme like AI? So what we like to do is quantify innovation. Everybody says they have the most innovative fund, the most innovative company. Well, what does that mean? Like, why are you innovative? And for us, we look at a company that's been able to change, a company that's had the ability to be nimble and almost, stay ahead of changing consumer habits, trends, and frankly, earnings. Where can you derive earnings from a new kind of theme or way of doing things? So what we found is companies within the NASDAQ 100 spend more than competitors in, say, the S&P 500 or Russell 1000 growth on research and development. So right off the bat, that tells me, okay, these are companies that are reinvesting back in themselves, because R&D is not a short-term fix, right? You don't throw some R&D money at a project and say, oh, this is going to hit my earnings next quarter. No, it's years down the road. And from there, we say, okay, these companies are really engaged in reinvesting in themselves. It's a large time commitment. It's a large dollar commitment. What are you getting for it? And we've analyzed patent filings across over 30 disruptive different technologies. And we found that companies within the NASDAQ 100 have filed over 20% of patents that relate to things like deep learning, like 3D graphics, like NLP, all these different AI adjacent technologies. And this isn't just in like the most recent iteration, which is 1 year ending November 30th, 2023. Right, this has been going on for years. So the infrastructure and the research around AI usage and adoption has been undertaken by these companies for a while now. A lot of it has already been built out. So I think as we start to look and see, okay, well, where are these companies going to derive future earnings from? I mean, it was, AI is going to be in 3 to 5 years. And then last year, of course, like that blew that whole thing up. And it's, okay, it's here now. Right. But you can kind of see where there's the connection between kind of diversified thematic exposure within QQQ. And I mean diversified in that, there's AI adjacent technologies, there's cloud, which is a really wide net that you can cast. There's stuff like bioinformatics and spacecraft and satellites, a lot of interesting technologies that are being developed. And frankly, you're starting to see patents being filed amongst this. So I think that's why you can see the connection between QQQ or QQQM and AI. And then we have certain thematic ETFs that I don't necessarily cover myself, but something like IGPT, which is looking at next-gen software and AI. So looking at companies that are engaged in AI in their underlying business and getting exposure in one ticker there. So that's a question that I get fairly frequently. Where do I look to get AI exposure?
So what I'm learning is Invesco is an innovator, not just your ETFs. You're doing deep dive research and really trying to isolate interesting investment opportunities and putting it into an ETF wrapper. Did I understand all that correctly?
Yeah, I think you did.
Wow. So I'm a good student of yours now. The other thing I learned from you is most of your ETFs are not cap weighted. And that kind of surprised me to have a suite of 220 ETFs and not be cap weighted, because we grew up in a world of market cap indices. Where did that innovation come from? Was that just potluck? Was that a conscious effort? How did that happen, and how did people respond to you having such a large suite of uncap weighted indices?
Right. So I think it was kind of kicked off with RSP back in 2003. And as we progressed through the 2000s, you sort of saw the rise of factor investing. It almost became kind of a theme du jour, right? Like
factor meaning, valuation like PEs or, cash flow.
Yeah,
is probably popular.
Yeah. I mean, ultimately trying to determine or figure out what is the driver of returns. And,
at a fundamental level.
Exactly. So, if you, depending on the work, you can look at factors being, they have to be persistent and pervasive and robust, intuitive and investable. And you have to have all of these things to come together to be a generally accepted factor. So like something like value, right? It has to hold true across multiple cycles. It has to hold true in multiple geographies. It has to hold true for multiple definitions. Price to sales, price to earnings, right? All different, basically indicators of value. And isolating stocks based on these different metrics all have to show outperformance over the course of market cycles. So, I think with that, we developed a number of different suites to play the generally accepted factors, and then building off of, other alternatively weighted indices that provide a type of exposure that may lean one way. And I think it's all about providing that choice. Ultimately, with 220 ETFs, if you're looking for a specific type of exposure, chances are we have something that might fit the bill. And they are going to have some level of nuance. We think that we've built ones that take advantage of, the robust factor premia that does exist. Like we want unfiltered and more pure factor exposure for a lot of our funds. And we think that serves both us and our clients very well as we kind of look and try to develop portfolios that can enhance risk reward over time.
So in using factors, there's something that's called multi-factor analysis, and you've applied that to a number of ETFs. Can you talk about a few of those?
Yeah, of course. And basically, multi-factor is the combining of multiple accepted factors with the ultimate goal of providing better risk reward than the market. We've taken, again, kind of an approach that it's not one size fits all. Right? Different clients are going to want different types of exposure. And as we look at the multi-factor offerings that we have ones like QVML, that's quality, value, momentum, and L stands for large cap. So we look at the S&P 500. We give every company in there a score based on quality metrics, value metrics, and momentum metrics. And we want to isolate the top 90%. So we're going to exclude the bottom 10. Ultimately, 50 names are going to get tossed aside. And with that, you're going to get a very S&P 500-like experience. right? With 450 names, the tracking error should remain pretty low. It should have a reasonably high correlation with the S&P 500, but it allows an investor to take somewhat of a factor view, right? I believe in the power of factors. I believe that these things work. It enables you to do so without going too far in any other direction, right? So S&P-like with a factor tilt. Then we have sort of the middle of the road ETF. It's BVMP. So it's Bloomberg, M is momentum, V is for value and low volatility, and P is for profitability. So we look at that as sort of a quality proxy. We give scores across all of those metrics: momentum, value, low volatility, and profitability. And we're going to highlight in each sector those that score in the top 90th percentile. Basically 50 to 55 names, and we equally weight them. So very different than 450 names, right? This is much more targeted, and it's going to be a little bit more static factor exposure, meaning you're trying to look at companies with high profitability, high momentum, value, and low volatility. So that's sort of the middle of the road offering. And then our other would be our dynamic multi-factor suite. You know, it has a bit of an active feel to it in that it moves around a lot. So we try to identify where we are in the economic cycle. And we base that off of a blended signal of leading economic indicators and something called GRACI, which is basically a global risk appetite indicator. And using those two metrics, we determine whether we are in a recovery, an expansion, a slowdown, or a contraction in the economic cycle. And given where we are, the ETF will overweight the factors that historically have outperformed in that given regime. So it moves around a lot. It's not uncommon to see 200+% turnover in a year. If you try to put it on your traditional kind of size and style box, in a recovery regime, it could look like a mid-cap value fund. Recently, in like a contraction or a slowdown, it looks like a mega-cap growth fund. But we've seen a lot of interest around this fund because the ETF will make the call for you. You don't have to be the one to say, you know, now's the time where value is about to turn and outperform growth. Lord, I mean, we've all tried, right? And it's just a really hard, it's just a hard thing to do. Timing the market is not easy. But what this will do is kind of base its investment decision, right, or its investment allocation on what has historically outperformed given the economic backdrop. And because it takes place in the ETF wrapper, it can enjoy years of 200% turnover. It can be very dynamic and move around a lot without necessarily the tax liabilities that you might see in another type of investment.
And how often do you rebalance that?
So we look at it on a monthly basis. Depending, again, it's going to be regime driven. So every month we look and make sure that we're in that same regime that we were in the month previously. If it changes, the ETF will change. So it's sort of a monthly basis, a monthly check-in. And we've seen years where, 11 months of the year is just in one regime. We're just in an expansion. And then there are years like 2022 where we saw all four regimes of the economic cycle within 12 months.
Wow. So what is it saying now?
So right now it's saying we're in recovery.
Okay.
So, we see kind of risk appetite slowly increasing, generally early cycle. And in this type of environment, it will overweight value in smaller size names. We haven't necessarily seen value in small size trade, like that performance take off. I mean, it remains kind of large cap growthy, but we're starting to see market breadth widen out a little bit. We saw it a little bit in December, I would say. We started to see mid caps outperform large, small caps start to perform a little bit. As I think the prospects for both an economic soft landing and the potential for rate cuts in 2024. We're seeing a similar narrative here where we're starting to see performance broaden out. I mean, 1 month certainly doesn't make a trend, as you well know. Better
and
than
cycle
pretty much
shifts
anyone.
can take months to happen.
Exactly. So it'll be interesting to see as we go forward if we start to see that performance widen out and if that small size and value performance begins to take off.
So let's say over the last quarter or so, let's say 3 to 6 months, where are you seeing the biggest inflows? What are the most popular ETFs that you're seeing get flows?
Yeah. So from the Invesco side, it's QQQ, it's QQQM. I think folks they want NASDAQ 100 exposure. I think it's transparency. It's pretty easy to understand. You know what you're going to own.
It's AI. It's innovative.
Exactly.
It's digital.
It's digital. So we've seen a lot of interest there. RSP, as you said, right? It had a very big year of flow last year, the year before that, even the year before that. We've seen the 3 best calendar years of inflows for RSP in its 20-year history. And I think, again, it's investors that are positioning as a way to diversify the broader large cap arena. The multi-factor, particularly OMFL, that's sort of the large cap dynamic story. We've seen a lot of interest there, as well as our single factor suites like quality. We've seen a lot of interest in large, mid, and small cap quality, as well as momentum, both from a large, a mid, and a small cap perspective.
So it's pretty broad and diverse what you're seeing in the marketplace.
Yeah, I think, when you're looking from the factor perspectives, ones that haven't necessarily performed, we haven't seen the flow. Ones that have, or ones that offer some level of differentiation, we've seen some interest.
Well, that's pretty typical. Money kind of follows return.
Exactly.
So where are not the flows, or where are you seeing outflows? What are people not interested in?
Low volatility mainly. I think from an Invesco standpoint, as well as just the street standpoint, we've seen outflows in the low volatility space. Us particularly from large to mid to small. S&P put out a really interesting blog on the S&P 500 low volatility index, in that it's in the 99th percentile of cheapness relative to the S&P 500. And by cheapness, really from a valuation perspective, they're looking at a composite of PE, price to sales, and price to book. And basically, again, the 99th percentile of cheapness of lower valuation versus the S&P 500. So I think that's interesting, right? I think from their perspective, there's a risk reward, potential looking to the low volatility suite. But, certainly over the past, let's call it 15 months, if you're in low volatility, you're underperforming.
That's because the market's up and there's been low volatility. Low volatility is in when there's high,
exactly.
Right? It's the contrary. It's the opposite, right?
Exactly right. And it works late cycle, right? When you're starting to see, some challenged equity performance, it works well on the downside. It's a good portfolio diversifier, but I think where it derives its outperformance is downside protection over the course of a market cycle. And without much downside in a year like 2023, right, there hasn't been a lot of interest.
And a great first quarter.
Yes.
This year. I mean, not often do you get 10% in a quarter after coming off of a very strong year where we were up 24% last year. So what are the top 3 questions that people are asking you now?
So the first, of course, would be AI, right? How do I get exposure there? The second is kind of what we touched on earlier, like what's the difference between QQQ and QQQM? Like I see they're both NASDAQ 100. And again, maybe just to quickly reiterate, QQQM is 5 basis points cheaper from an expense ratio perspective. So 15 basis points versus 20 for QQQ. QQQM is an open-ended ETF versus QQQ being a UIT. And in that structure, you have a little bit more flexibility to do things like lend securities and reinvest dividends at the fund level, which we think over time will help to
helps to add to return, right?
Exactly. Helps to bring excess NAV performance. And then the third is sort of like, how do I incorporate factors into my portfolio? Like, I think this is a big thing that is a challenge for all of us, is that we don't invest in a vacuum. Very rarely do we just get a pile of cash and it's like, okay, go ahead. Like, talk to me about your asset allocation. What do you want to do with this? There are pieces that may have been held for 10, 20 years. There are tax considerations that we need to take into account before wholesale changes are made in a portfolio. Some of these positions may have been held for a number of years, and it's, well, what happens when I add this new strategy in? Like, how does that affect the broader, scope of the portfolio? Will it change the way that it behaves? So I get that question quite a bit, and I think it's an important one because, you need to understand kind of the drivers of each fund, each strategy that you're using, when it will perform, and maybe more importantly, when it won't perform. So it's really going out and finding that education, looking at your portfolio, finding out where there's blind spots, what something that may be added, what consequences that may have within the portfolio. So that question gets asked quite a bit, and truthfully, I'm not all that surprised by that.
When I first came into the business, there were no ETFs, so that tells you a lot. And they started getting adopted, and the SEC didn't allow certainly broker dealers to put a rating on an ETF the way we put a rating on different companies. But now we're in an environment where the diversity of ETFs has expanded, which you've talked a lot about. And now there are certain people, certain firms, really not people, certain firms putting ratings on ETFs. Do people ever ask you about that, about ratings? Do people find ratings helpful? What about the world of ratings for exchange-traded funds like companies?
Yeah, I think from time to time, right, I get the question about ratings. So this ETF has a certain rating that I saw on the internet, or from my particular broker dealer, and I think it can be helpful. And I think there's varying degrees of ratings, right? There's sort of the traditional kind of stock rating, buy, sell, hold. And then there's also platforms where, okay, this is eligible on our platform, or this is a recommended ETF for a certain theme. Ultimately, I'd kind of loop them all together as like a helpful starting point for folks. I mean, you look at the world of ETFs, we're well over 3,500 ETFs that are listed. That's a lot. That's a lot to sift through.
Yes,
and understand, right? So I think for those that are investing clients' money, it's a great first stop, kind of like a
first screen.
Exactly, the first screen where it's okay. These have been vetted. Let me take a deeper look at these. These are kind of worth my attention. So I think it certainly helps in that regard. But again, we're not in a vacuum. And one ETF that may be a buy or a recommended may not be the right one for a given client or a given model portfolio. So I do encourage advisors and those that are building out portfolios to certainly use that as a great starting point, but do your own research, seek opinions from elsewhere to try to determine exactly where that ETF would fit.
Well, I certainly learned today in this conversation, you got to do your homework.
Yes.
That there's a lot out there, and sometimes you just have to do a little bit of the deep dive to understand what some of these ETFs are trying to achieve.
Yes.
We've talked about a lot, Ryan. I'm sure there's a lot more that we can talk about. So what didn't we talk about that you think our viewers should know?
I think you just got into it. It's the educational portion of it. There's just a lot to learn, and I haven't found anybody that has learned all of it yet. Right? I try to find that person. I haven't been able to yet. But use the resources that are out there, right, to try to get this picture of knowing what you own or knowing what you're considering to buy, right? I think the educational portion is a huge one for me, because I think it can alleviate a lot of the concerns or a lot of the disgruntled questions that we'll sometimes get on, I'm looking at a certain ETF or a certain sector of the market. Why isn't it performing? And I think having a deeper understanding of the way that index construction begins, and thus how ETF kind of tracking that index, what that will contribute to the overall portfolio, I think helps a lot in terms of conversations with clients. So knowing what you own, knowing what to expect is a big one. And there are a ton of different educational resources out there from online, from an Invesco standpoint, we have a portfolio solutions team that will go and x-ray a portfolio, talk about where there may be lacking factor exposure, things of that nature. There are tools that look at ETF overlap. There's just a lot that's out there.
So look at the resources of the ETF providers.
To know what you own.
To know what you own or what you might want to own.
Exactly right.
Ryan, this has just been a wonderful deep dive conversation into the world of the opportunities for owning ETFs at Invesco. So thank you very much for joining me here today. And I want to thank all of you for tuning in as well.
Thank you for watching or listening to the Friends of Sanctuary podcast. Tune in next month to be sure not to miss out on the next installment of the series.
Sanctuary Wealth consists of the wholly owned subsidiaries, Independents, and Sanctuary Advisors, LLC, SEC-registered investment advisors, Sanctuary Securities, a FINRA member broker-dealer, as well as Sanctuary Alternative Holdings, Sanctuary Asset Management, Sanctuary Insurance Solutions, Sanctuary Global, Sanctuary Global Family Office.